And now I would like to take a moment to introduce Peter Fissinger. Peter Fissinger, president of Campbell Company, has 27 years of professional experience in institutional advancement, and he has been directly involved in designing and implementing major capital fundraising, annual giving and planned giving programs, and marketing and publication efforts. Peter has served a wide range of nonprofit institutions, including independent schools, higher education, healthcare, and cultural organizations. Peter is the chair of the Advisory Council on Methodology for Giving USA, a member of the board of the Giving Institute, a past president of the Chicago chapter of the Association of Fundraising Professionals, a member of the Council for Advancement and Support of Education, a member of the board of the YMCA of Metropolitan Chicago, and a member of the Naperville Historic Preservation Commission. He is also a frequent lecturer at a variety of institutional advancement conferences. And now I'll turn it over to Peter. Peter?
Thank you very much, Sarah. And I want, on behalf of my colleagues at Campbell Company, I want to welcome you all to this webinar dialogue this afternoon. Frankly, as moderator, I'm very interested to hear what our panelists will have to say on this important topic. I think the context in which we're having this dialogue is that we fundraisers continue to operate in very uncertain times. I think we're still recovering from the 50% drop in the Dow Jones Industrial Average from September 2008 to March 2009. Giving has recovered. It recovered slightly, especially in 2010, but the pace of recovery is such that at that pace, it would take 5 years for us to get back to where we were in inflation-adjusted dollars in 2007. So I think we began to feel that things at least settled into a new normal if things had not returned to normal. And then we began to experience this significant discussion of the possibility of a double-dip recession, and that was a little frightening to us all. In the midst of all of this, there's been very substantial dialogue around the charitable deduction. Will it change? What does that mean? What should we be doing? We have a group of panelists to go through this topic with us. I apologize. And they're really terrific panelists. I'm going to introduce them to you now. Jeffrey Plague is the Director of Government Relations at Independent Sector, the leadership forum for charities, foundations, and corporate giving programs committed to advancing the common good in America and around the world. But prior to joining Independent Sector, Jeff served as Advocacy and Policy Director at the Basic Education Coalition, a group of international development organizations dedicated to providing every child around the world access to a quality education. Jeff previously spent 15 years working in the United States Congress, and in 2008, the New York Times called him a well-respected Capitol Hill veteran. Dr. Una Osili is the Director of Research at the Center on Philanthropy at Indiana University, a leading academic center dedicated to increasing the understanding of philanthropy and improving its practice worldwide. Dr. Osili is the current chair of the Research Committee of the Women's Philanthropy Institute and is a member of the Research Committee of the Lake Institute for Faith and Giving. She leads the center's extensive research program for its partners, including the Bank of America, United Way Worldwide, United Student Aid Funds, the Alban Institute, and National Collegiate Athletic Association. Stephen Taylor is the Senior Vice President and Counsel for Public Policy for United Way Worldwide. Steve spent over 10 years working in various capacities as a staff member in the United States Senate, and most recently serving 2 years as General Counsel to U.S. Senator Chuck Hagel of Nebraska. Steve served as Senior Counsel on the U.S. Senate Judiciary Committee's Subcommittee on Antitrust, Competition Policy, and Consumer Rights for 6 years. Steve also served as Chief Legislative Analyst for the Minority Leader in the New Mexico House of Representatives. I want to thank and welcome all our panelists for being here. Now, before we start, we thought that we would give a little bit of overview and context to this discussion. And let's start with just some history on the charitable deduction itself. We think of the deduction sometimes as being brand new, but in fact, it's been with us since 1917. It's been around almost as long as the income tax code itself. And so it was initially capped at 15% of income, and income taxes initially were limited to high-income earners. In 1940, the income tax expanded to 75% of the population, and that's when the standard deduction was introduced. And you'll note that 2/3 of all filers do not itemize and therefore are able to use the standard deduction. And except for 1 year in 1981, I'm not sure exactly why, but in 1981 the charitable deduction has been limited to itemizers only. Now, I think it's important to point out that tax rates have varied substantially over the years. We think of it being, in the range that it's been for a long time, but in fact, if you look, in 1980, the highest income bracket was taxed at 70%, and that has changed over the years. Currently, it is at 35%, and the most recent proposal is to bring that bracket back up to 39.5%, which is where it was prior to what were known as the Bush tax cuts. And the important thing here is that these tax rates really impact the cost of a gift. A simple model shows us that, I think I went backwards here, sorry. A simple model shows us that just at the 25% tax rate, a $1,000 gift costs $750, and at the 50% tax rate, a $1,000 gift costs $500. So effectively, the federal government is partnering with us to support nonprofit organizations of our choice and encouraging us to make a difference in our society. We know that the tax deduction is not the primary motivator for the reason that people give, but it can often be a reason that people increase their gifts. And we've grown very comfortable with encouraging our constituents, our donors, and our prospective donors to use the deduction to their advantage. So it's something that we like, we're comfortable with, we're used to it. So what's driving this debate? I think there are a few important things to point out here. Obviously, there are record federal government deficits. I did a little bit of reading recently and noted that in the year 2000, we actually had a $237 billion surplus, and in 2010, the deficit was estimated at $14 trillion. That's kind of moving in the wrong direction, if you know what I mean. To make it more complicated, 88% of spending is entitlement spending, military spending, or the interest on our debt. So when we look at how we're going to handle deficits, it's a very complicated problem. Secondly, the Obama administration has really been seeking funds for its priorities. This is not the first time the administration has recommended a cap on deductions or resuming the tax rates as they were prior to the Bush cuts. In the first two budgets that they introduced, this provision was included. In the jobs bill, this provision was included. In health care reform, this provision was included. So there has been a motivation on the current administration to cap the deduction. Secondly, third, the current deduction is really targeted toward wealthy taxpayers, and some feel perhaps that's not appropriate. But remember, only a third of taxpayers itemize, and the higher tax brackets drive a higher subsidy. So there's been dialogue about whether or not this is the best way to support the nonprofit sector through deductions. And then correspondingly, data suggests that the deduction favors certain kinds of nonprofits for the very reason that more wealthy donors tend to support certain kinds of nonprofits. And so there's a question of whether the deduction equitably supports the nonprofit industry, or because it's targeted toward wealthy donors, perhaps certain kinds of nonprofit organizations benefit more than other kinds of nonprofit organizations. So why are we concerned? I think to some extent it's just that we're very accustomed to having this deduction available to us as we talk to donors, that the government is partnering with them as they consider how to make an impact in society. And we saw some of the simple ways that the deduction works, but we all know when you start looking at more complicated gifts that there are other ways that we can lower the cost of a significant gift to a nonprofit organization. Well, you know, the deduction may be targeted toward wealthy donors, but the truth of the matter is that wealthy donors account for a disproportionate amount of all giving. If you look at 2008, 13% of taxpayers accounted for 58% of giving. We're already pressed by the recession, and lost government support at both the state level and the federal level. And so I think we're already looking to donors to make up a larger portion of our budgets. And I think we worry that this 28% cap could lead to other reductions in the future. So that's sort of an overview of the discussion here. And, you know, I just want to point out, I'm not going to go through this slide entirely, but I'd just like to point out that these slides are just jumping around here. I apologize. The current proposal is part of a much larger dialogue about how the tax code could be used to support nonprofit organizations. And this is just a summary of some different studies that have been published recently, which have suggested different ways of using the tax code, creating a floor above which gifts could be deducted, allowing all taxpayers to claim a deduction, to replace the deduction with a non-refundable tax credit, and that tax credit level has varied in different studies. So there's been a wide dialogue of the different ways that the tax code could be used to support nonprofit organizations. And the current proposal that the Obama administration is advancing, and I think they've been fairly consistent in this, is twofold. First of all, put a cap of 28% on the deductibility of gifts. And secondly, raising tax rates to those who are in the highest income bracket. So the highest bracket would go from 35% to 39.5%. The reason that second provision is important is because obviously it reduces discretionary spending available to consumers, and gifts are made from discretionary spending. So it's really a twofold proposal. And I think we've found, if you follow different studies, that it's very difficult to estimate what the impact of this proposal will be, therefore heightening the dialogue, frankly, on both sides of the discussion. Here are 3 different studies that have been published in 2011 that show significant variation in the estimated impact of this proposal. The Center study, which was done by the Center on Philanthropy, was funded by Campbell Company, and if you're interested in reading that study, you can go on our website. It's right on the front page, and you can click through and read it. And we're going to have Una tell us a little bit about that study in a few minutes. With that, I would like to turn this over to a discussion with our panelists, and I'd like to just start by having each of you tell us a little bit about yourselves, the organization you represent, and the role your organization is taking in the dialogue regarding the current proposed changes to the tax code and the treatment of charitable giving. Maybe just a couple or 3 minutes each. And Jeff, since you're the first one pictured on our slide, I'm going to ask you to go first.
Thank you very much, Peter. I very much appreciate the opportunity to be with you all today and to speak to folks about what we think is a very important issue. I'll talk just a little bit about the organization I work for. I think you did you gave me a very complimentary introduction. I appreciate that. Independent Sector is a coalition of nearly 600 nonprofit organizations around America. Our membership spans both charitable organizations, foundations, and corporate giving programs. And in addition to a number of sort of leadership and good governance activities that we undertake for our members on the policy area, or on the policy arena, we focus on issues that affect the environment in which nonprofits are able to work. So we focus our attention almost exclusively on tax issues related to the treatment of charitable giving, questions around the exemption of nonprofit organizations, things like that. And so our work tends to be focused, and our attention tends to focus on the tax writing committees in the House and the Senate, as well as leadership offices. We have identified, and as have sort of most organizations in the sector, the charitable deduction and the threats to the charitable deduction is one of our most pressing, if not our most pressing issue this year. Just a real quick overview of some of the things we've been doing, and I'm happy to sort of take questions or get into further detail if anyone has any interest. We try to get our member organizations exposed to as many key congressional offices as we can to convey the message about the importance of the nonprofit sector to communities across America. So far this year, we've had about 150 meetings on Capitol Hill. Many of those have included independent sector members, and frankly, Steve Taylor's been in probably more of those meetings than he cares to remember, helping us make the case for the importance of the charitable deduction. We've sent out to RIS members about 20 calls to action this year, urging them to be in contact with their representatives here in Washington to communicate the importance of charitable giving and the need to preserve the charitable deduction for the work that they're doing in communities across the country. One last thing that we did in July, we sent a letter to the White House and congressional leaders that had 127 signatures from nonprofit CEOs working in all sectors in most states and communities across the country, urging protection of the charitable deduction in the context of deficit reduction negotiations. We continue to take signatures online. I think we're up to 370 signatures now on that letter, and we did run it in July also as a full-page ad in the Politico newspaper to sort of help amplify the message and make sure that policymakers saw how important this issue is to our sector. So I'll sort of leave it there and look forward to getting into a discussion and answering any questions folks may have.
Thanks, Jeff. I was telling Jeff this morning when we were talking on the phone that I have found independent sector's materials to be very useful, and used some of the information that they sent us to send one of the first letters that I did to our congressman about this very topic. So I'm very appreciative of the work that you've been doing. Una, tell us a little bit about the Center on Philanthropy and the Center's role in this dialogue.
Yes, thank you very much, Peter, for such a great introduction and for framing these issues so nicely. And also thanks to Jeff for his overview of the work being done at independent sector as well. Just a quick introduction about the Center. The Center was founded in 1987. It is the oldest and largest academic center dedicated to the study of philanthropy. The Center is also a recognized leader in academic programs, in training programs, as well as research. And one distinguishing feature of the Center's work is that we believe very strongly that research informs practice. In other words, research within the sector can improve practice, but also that practice can inform research. So we really see research and practice as having a two-way dialogue. And the Center's mission is to increase the understanding of philanthropy and to improve its practice globally. And that explains, I think, largely why the Center has been at the forefront of work around the charitable deduction and the relationship between charitable giving and tax incentives. In 2009, the Center authored a white paper looking at proposed changes in tax policy and what their proposed impact would be on charitable giving overall. And in 2011, with more dialogue and much more discussion around proposed reforms to the tax code and to tax policy as it relates to charitable giving, the Center, in partnership with Campbell Company, essentially reviewed the work we did in 2009 and updated that work to make it relevant to the dialogue. Our goal is really to provide rigorous research to inform the discussions and the debates taking place, and also to demonstrate that within this dialogue, the nonprofit sector and charitable giving should be considered in making, I think, effective policy. Certainly the role of the nonprofit sector and the role of philanthropy should be considered, and that's really where we have placed ourselves within the context of this debate.
Thank you, Una. I know we've been partners with this center for many years and really appreciate the very good work that your organization does. Steve, you've been very active in this dialogue as sort of one of the lead people within United Way. I know that your CEO was actually testified to Congress a couple of weeks ago on this topic. Tell us a little bit about yourself, the organization, and how you all have been participating in this dialogue. Steve, do we have you? Okay, well, let's move forward. Hopefully Steve will dial back in just a minute. After a call that we had this morning, I actually wrote my congressman again because there have been some new developments on this topic. Jeff, you want to tell us what just happened yesterday on this issue?
I will. Thanks very much, Peter. As you may know, the Joint Select Committee on Deficit Reduction was sort of an outgrowth of negotiations this summer about the need to increase the statutory debt limit. Congress ultimately gave President Obama the authority to do that in conjunction with, I think, off the top of my head, about $918 billion worth of deficit reduction measures that were also enacted into law at the same time, as well as language calling for the creation of this Joint Select Committee on Deficit Reduction that was charged with finding at least $1.2 trillion in additional deficit reduction to be recommended to Congress by November 23rd, so 2 weeks from tomorrow. Congress then has until December 23rd to pass those recommendations by a simple majority up or down vote in each chamber. And then President Obama has a deadline of January 15th by which he has to sign into law those deficit reduction measures. Failing that, effective January 2nd, 2013, $1.2 trillion of automatic spending cuts will take place through a process called sequestration, and the spending cuts will be split evenly between domestic discretionary funding and defense spending. And so there's sort of a carrot and a stick for both Democratic and Republican members to try and avoid having that sequestration take place. Anyway, that may have been more background than people needed. The super committee, as the Joint Select Committee on Deficit Reduction has become known, is facing a fast approaching deadline, and they have made, by all accounts, sort of sporadic or haphazard progress towards reaching compromise on $1.2 trillion in deficit reduction. When we can get into sort of specific questions if people have them. Anyway, yesterday, Senate Republicans, in what would apparently be on its face in a shift from previous positions, reportedly signaled their willingness to accept about $300 billion in revenue increases as part of the deficit reduction process, but only in exchange for permanent extension of all 2001-2003 tax cuts for all taxpayers, which Democrats immediately sort of rejected as a pure political ploy and an attempt to make permanent tax cuts for the wealthiest Americans. So what we think this signals, more so than sort of a change in heart on the part of Republicans about not wanting revenue increases to be part of whatever recommendations come from the Joint Select Committee, it does, we think, signal clearly that tax revenue questions, including the charitable deduction, do still remain on the table as part of the ongoing discussion. And so we think it continues to be important for the nonprofit sector to make its voice heard. We actually are working on getting out later today another message to our members, particularly targeted to organizations that have presences in states and districts of supercommittee members, to once again make clear, as they sort of try to wrap up their work, that the charitable deduction is important to the work of nonprofits and needs to be preserved. So.
Peter, are you there? Sorry, we're having a little bit of a muted problem. I think people are muted.
This is Steve.
Do we have you, Steve?
There he
had
is.
Me, and I was on for the entire beginning, and I heard Jeff and Una, and then when it was my turn, I started talking, but you all couldn't hear me, so I'm back on. Unfortunately, I missed a little bit of Jeff's presentation, but
you've heard it all before, Steve.
I have, and Jeff and I work really closely together. What I wanted to say during my little opening was just thanks to Peter for hosting this webinar, and we really appreciate the work of Campbell Company, and I think doing this webinar today is very timely and important. I'm honored to be on this panel with Jeff and Una, and as Jeff said, we've acknowledged we work really closely together, and of course everybody's familiar with the work that Una does at the center at Indiana University. So it's great to be here. If I can have a second just to talk about United Way, to go back to that part, I'll say that United Way is the largest privately funded public charity in the United States. So we raise about $4 billion a year. 95% of that is from private sources. There's a small amount of government money that goes into some United Ways, but almost all our revenue is from private sources. We have about 9.5 million individual donors, but about 28,000 of our donors give $10,000 or more a year. So the tax incentives is hugely important to us. I remember in late February of 2009 listening to the radio in the morning before I came into work about this announcement that the administration's first budget outline had a proposal to cap the charitable deduction, and I thought, wow, that's going to be a big deal for us, but I hadn't really foreseen just how much time I would be spending on it on the subsequent 2.5 years. So it's a huge deal for United Way, and we have been working very hard on it. So that's my part about United Way, and we can move on with the other questions you were talking about.
Thanks very much, Steve. Appreciate it. I think nonprofit organizations are very concerned about these proposed changes to the treatment of charitable giving in the tax code. But we know that the economy is the biggest driver of philanthropy, and we also know that most donors decide to give before they decide or try to calculate the cost of giving. I think in all of this dialogue, there's considerable disagreement about how important the current laws are to charitable giving. You certainly hear it in the political spectrum. I'm interested to hear from our panelists. How important are these laws? Jeff, your organization has been very much involved in the dialogue here. What say you on this question?
Thanks, Peter. It is a good question. It's a question we get asked quite often when we're on the Hill. And we acknowledge, and I think all nonprofits that we interact with and engage with recognize that people give to charitable organizations whose missions they care about, who are working to solve a problem that they think is important in their community or something that has touched their life in some way or another. And so we recognize that charitable organizations sort of are able to survive because of the generosity of the American people. But we also think that it's very clear that people do make decisions about when and how much to give based on the tax implications. And I'll just use sort of two examples or sort of specific instances that we tend to use and actually find to be helpful in our conversations with congressional staff. And the first that really underscores, I think, how attentive taxpayers are to tax policy when making giving decisions was highlighted in a study that Network for Good conducted last year. Results were released late last year that looked at online charitable giving patterns. And from 2003 to 2009, about $281 million was donated online to charitable organizations. And of that giving, 22%, just over 22% of it took place not only in the month of December, but on the last 2 days of the calendar year. So December 30th and 31st, more than 1/5 of all online charitable donations were made. And it's very clear that people are doing that because they recognize that they need to make it by December 31st if they want to take the deduction on that year's tax return. We think that's a pretty compelling and powerful illustration of how attentive donors are to the tax implications of their decisions. And secondly, Congress themselves, on a number of occasions, have recognized the incentive effects of the charitable deduction on people's giving behavior. In the days after the January 2010 earthquake in Haiti, Congress actually passed legislation, the President signed it into law, that extended the period for which or during which taxpayers could make a donation into calendar year 2010 and still take a 2009 tax deduction for donations made to Haiti relief. And it wasn't the first time in recent years that they've done it. Similar extensions were enacted following the Southeast Asia tsunami of 2004, Hurricane Katrina in 2005, and storms and subsequent flooding in the American Midwest in 2008. So we know that there is an impact and a correlation between tax policy and the tax implications of giving and people's giving behavior.
Steve, by the way, I took advantage of that extension, so I was happy that we did that. Steve, do you have anything to add on? Add to Jeff's comments on this topic?
And I will add, and I think it goes to in your question, you said that most donors decide to give before calculating that after-tax cost of giving. What I would say is that our experience is that those donors, and I'll concede that it's a minority of donors, but those donors that do calculate, that they seek the advice of an accountant or a tax lawyer or whatever as they are making their planned gifts, they do calculate in advance. They do know what the impact is going to be on their taxes, and they make the calculation in advance, and it does affect how much they give. They may have made the decision about where they're going to make their donation. They may know the range of what they're going to make, but at the end of the day, knowing that the tax implication, what our concern about the cap has been right out of the gate was that it's those donors, the high-end donors, and in your slide earlier you said that you talked about the disproportionate amount of giving by the people at the top end of the economic spectrum. Our concern is that those donors, if the charitable deduction was capped, and there's lots of other proposals now, but initially it was this cap, that they'd simply withhold the difference from their donation to pay the additional tax that would result of the cap. And that really is our experience from talking to our major donors.
I think any of us who have worked with high-end donors, those who have complicated financial situations and who have the capacity to make big gifts, have experienced that while they want to give to make a difference, the amount they give does really depend on the various advantages available to them in a given year. The next question that I want to ask is first going to be directed to Una. Earlier, I showed 3 different studies on the impact of these proposed changes, and the impact ranges from a little over $1 billion to $5.6 billion. So there's considerable, I don't want to call it disagreement, but range of estimates on the impact of this proposal. Una, what are the ways that we are able to measure impact, and what are the limitations, and what do we know or can we know about how these changes are going to affect our nonprofit organizations and our donors' decisions?
Well, Peter, thank you for framing that question so nicely. I think you are correct in stating that there is a wide range of research on this topic, and certainly different estimates on the impact of the proposed tax policy changes. Why do these studies differ in the size, perhaps, of the impact that they find? And note, all of them show a negative impact, but they range in their magnitude. In general, the underlying reason for these differences is that each model makes a different set of assumptions around how donors respond to these tax policy changes. And although the academic research is pretty clear that donors do respond to the tax incentives that are in place, the size of that responsiveness, the degree to which donors respond to these tax incentives does vary depending on the type of study, the type of data, and the assumptions that the authors make. So the case in general, the case for the charitable deduction is stronger when donors are more responsive to these tax changes. We also know that the impact of the proposal does depend on the specific rates that are considered and the timing of those proposed changes when they are implemented. In other words, the more complex the set of assumptions are, perhaps the more realistic the model is, but it also means that each study is making a different set of assumptions and getting a different set of results. I think what unifies all the studies is that they do show a negative impact. A smaller assumption around the responsiveness of donors to the tax price does lead to smaller estimates, and assumptions around more responsive donors does yield a higher estimate. So the range is anywhere from about $1 billion less in charitable giving to about $5 billion, $5.3 billion less. So there's certainly a range.
When I read through these various studies, there are certain commonalities in the measurements that are made and the exceptions to those measurements. It appeared to me that the various studies acknowledge that they're measuring the impact of giving based on what happened in a given year, and that the extent to which donors may adjust to laws over time is not measured with 100% accuracy. Am I reading that right?
I think you're correct in stating that there are two other issues that come up repeatedly in these studies, and that's how do donors perceive these changes? Do they think they're going to be temporary changes, in which case they may not adjust their behavior very much, or do they think these are permanent changes, in which case they may actually respond more? The other question is the timing of these proposals. If these are going to be phased in 2 years from now, donors may actually pre-give, in other words, give a lot to charities now to take advantage of the incentives that are in place, in which case studies down the road may not find much of an impact. So I think most scholars who have looked at this very carefully have recognized that it's not just the proposals that actually are implemented, but how they're implemented that will affect donors. And I think all my colleagues on the panel, Jeff and Steve in particular, have noted that high net worth donors are particularly impacted by these proposals. Another piece of research that I should just bring to bear on this topic is our work in partnership with Bank of America on high net worth donors. What we found is that in this economic climate in particular, donors are looking more carefully at the tax incentives they get for their charitable gifts. Just as one piece of evidence on this topic, we've been conducting this study since 2005. When we asked the same question nearly 5 years ago, we asked donors, if tax incentives for giving were to go away, would you change your giving? And most of them said no, they wouldn't change their giving very much. In the most recent study, we asked the very same question on the survey and found that actually a larger share of our donors would actually change their behavior. And fewer households, less than half, for the first time, about 30%, only 30% said their giving would stay the same. So we are seeing that in this economic climate with more uncertainty around wealth, around incomes, the donors are looking carefully not just at where they give their gifts to, but how much and the manner in which they give as well.
I was very interested to read that in the Bank of America study, and I was also interested in another study to read, which when I read it, it made a lot of sense, that it's far more accurate to research what donors actually do than it is to research what they say they're going to do under circumstances that may or may not come to pass. So I was just reading up for this webinar has been a lot of fun. Steve or Jeff, do you have anything to add to this topic about measuring the impact and the uncertainty of it, if it could be larger than what is estimated?
Well, what I'll say is that the variation in these studies has presented somewhat of a challenge for those of us who work in advocacy and do public policy work on this issue. And so, what we realized pretty early on, though, is that all of the studies indicated some reduction in charitable giving. And there's, and because of this issue around elasticity and, what is the appropriate amount of elasticity and that uncertainty around that, that I think Una was talking about a little bit, we ended up focusing on what the result would be if there was reduction in giving, because all the studies do conclude that there'll be reduction in giving. And, the bottom line for the sector at this point, because, we've been through this economic crisis too, we have trimmed our staffs. We found every efficiency that we can possibly find so that we can continue to provide services to people who need help. And, at this point, any reduction in giving as a result of a reduction in the charitable giving incentives in the tax code, any reduction would result in fewer services to people who need help. And that would happen at the worst possible time. With government cutting its funding for programs, we're really the only place left for people to turn and to turn around. And, it would be them who would be, shouldering the burden of the reduction in the charitable giving incentive. It's not really the donors so much. It's the people at the bottom who get our help. So I think that the studies are really important. I think they show a lot of uncertainty, but I think that if you just focus on that, you aren't really looking at what the ultimate impact of the policy change would be.
I would echo Steve's comment, and I would also add that we, in our meetings and discussions with folks on the Hill, are actually sort of using the range of estimates and the uncertainty about what the ultimate impact would be to say to people on the Hill, look, we don't know what the impact is going to be or what the exact impact on charitable giving is going to be. We know it's going to be negative. We know giving is going to go down. And given the declines we've already seen, a $25 billion decline in giving we've already seen since 2007, the increased demand for services, state and local governments starting to turn to nonprofits for payments in lieu of taxes, now isn't the time to be debating whether or not the nonprofit sector can absorb a $1 billion reduction or giving or $2.4 billion or $5.6 billion, whatever it might end up being. We don't know enough to know, and that in and of itself should give Congress pause before making any changes to the charitable deduction. And as Steve said, the sector cannot afford further reductions in giving.
I think whenever we're having dialogues like this in Congress, we wonder not only what the outcome of this discussion may be, but what is the next discussion that this discussion could cause to develop. And so the current code has been suggested by some to be focused on the wealthy, and that the current proposed changes have been criticized because they target certain kinds of nonprofit organizations. In other words, it's known to some degree that wealthy donors favor education, arts and culture, and healthcare to some extent over some of the other nonprofits out there. Is this a precursor to redefining what a charity is? Does anybody have a comment on that question?
Well, I have, it's Steve, and I have a couple of comments. The first comment is I think you're absolutely right about the empirical evidence of wealthy donors giving to certain kinds of charities. But that doesn't mean that's the only place that they're giving. And United Way, for example, about $500 million a year comes from donors in that high-end income category. So they may be giving to museums and universities, but they are also giving to charities like United Way. And I think with regard to the larger question is, does this mean that at some point in a larger tax reform debate, which I think is coming, are they going to be looking at exempt status and what qualifies as a charity and what gets what gets exemption, and maybe do certain charities get do donors for certain charities get a different kind of deduction? And I think that is an extraordinarily dangerous road for Congress to go down. And I think that United Way, even though we're not one of the charities that probably would be under scrutiny in that kind of conversation. I think that we'd be really concerned about Congress trying to start to draw lines in the tax code about what a public benefit is and who's contributing to their communities. And because, and actually Jeff's probably the better one because he has lots of members who are those organizations, but, so I'll defer to him on this. But, I think there's lots of value provided by those organizations.
Thank you very much, Steve. I will sort of answer the second part of that question, but I wanted to sort of follow up on the first point that Steve just made about high net worth donors and where they give. And actually there was a statistic in the study that Una mentioned a few minutes ago that they did with the Bank of America. The most recent iteration of it that I think came out in November of last year, there's a statistic in there that demonstrated that 85% of high net worth households donated to basic needs charities in 2009, compared with 31% of all other taxpayers. So that sort of flies in the face of the conventional wisdom that wealthy donors give only to arts organizations, institutions of higher learning, healthcare organizations. Now, the dollar amounts don't necessarily reflect the percentages I just gave you, but the fact is that all donors give to a range of charitable organizations, and I think all nonprofit organizations are concerned about a decline in charitable giving. It's not just arts organizations and institutions of higher learning that we see sort of working actively on the charitable deduction. This would have an impact on nonprofits working in every sector of the nonprofit community. To answer the question about sort of Congress looking into questions of tax exemption for nonprofits, we're frankly already starting to see it. Senator Grassley, during a Finance Committee hearing earlier this year, suggested he has not formally submitted the request, and it's unclear if he's going to anytime soon, but he did publicly suggest that the Joint Committee on Taxation ought to score not just the cost of the charitable deduction, which is part of what they take a look at every year in terms of the cost to taxpayers of the charitable sector, but he suggested that in fact the charitable exemption itself ought to be scored, that Congress going into the tax reform discussion needs to have an understanding of how much tax revenue is lost every year because nonprofit organizations are exempt from paying taxes. We've also seen the House Ways and Means Committee this year conduct a hearing into the commercial activities of AARP. Chairman Bustani, subcommittee chairman for Ways and Means Subcommittee, submitted a letter to the IRS just several weeks ago asking for a number of questions to be answered regarding oversight and compliance of tax-exempt organizations. And we've heard from the Senate Finance Committee staff that they are interested in looking into the sort of blurring lines between for-profit and nonprofit organizations. A number of states have already begun creating new corporate classifications. Some of them are called for benefit, some of them are called limited liability, low profit corporations. So to think that the discussion going forward in Congress is going to be limited just to the question of the tax deduction and then the treatment of charitable giving, I think sort of, as you alluded to, Peter, kind of loses sight of the bigger picture, and there are much bigger sort of discussions that are coming that we need to be prepared for.
I'm reminded by your comments of a study that we funded with the Center on Philanthropy a few years ago, focusing on the arts and culture donor. And to your point, the arts and culture donor, when compared to the larger donor population, tended to live in urban areas, tended to be more educated than the average donor, tended to give much more money than the average donor, and tended to support a wide range of organizations. And there's other evidence to suggest that when there are very difficult economic times, that those donors temporarily slow or halt their giving to arts and culture organizations and increase their giving to organizations that provide basic human needs.
I'd love to see that, Peter. This is Jeff. If you can share that, I think that would be another sort of arrow for us to put in our quill when we're communicating with folks on the Hill. So I'd love to follow up with you offline and talk about that.
Be happy to do that. You know, is it ironic that this dialogue is coming at a time when we're looking to cut government spending, and the only kind of government spending that can easily be cut, you know, that's not entitlement spending, that's not interest on the debt, and there's going to be some very serious argument about any significant cut to military spending is discretionary spending. So what does this mean to nonprofits if they're looking at an unknown impact of the reduction of the charitable deduction at a time when they're also seeing discretionary spending cut, which will often impact spending toward nonprofit organizations?
Sorry.
Oh, go ahead. I was just going to mention one quick point about the current environment. We have been tracking how the economy is affecting charitable giving with our annual Giving USA report, and we did see during this current recession that we had one of the steepest declines in giving in recent years. So this is certainly a very challenging environment for nonprofits. And so this is an additional reason, I think, to consider the impact of these tax policies, and also to think about the unique place that nonprofits have in American society in providing for individual and societal needs. So I think this is also an opportunity for nonprofits to highlight their unique place in addressing some of these needs during the current recession.
So from United Way's perspective, we're not entirely sure that the nonprofit sector, the small nonprofits that are out in communities across the country that are really doing on-the-ground work, we're not sure that they really completely comprehend what's coming and the impact of the cuts that you talked about, Peter, the impact that it's going to actually have on them and their ability to provide services. You know, United Way funds 37,000 agencies nationwide, but those agencies are, many of them, probably a vast majority of them, are also receiving government funding. And in fact, on average, an agency is receiving about 5% of its funding from United Way, and at the same time they're receiving about 40% of their funding from government sources. And so we have at least been trying to communicate out to our United Ways across the country and to have them pass the message on to the agencies that they fund that it's going to be really, really ugly. It's going to get a lot worse, and you know, we at least want them to know that that's what's coming. So yeah, I mean, it really is. It's going to get tough.
There's a question or two I want to make sure we cover before our time is done here, and we are getting to the end of the hour. You know, the current treatment of charitable gifts in the tax code has been criticized by some because it focuses on wealthy individuals. The code is progressive. Gifts are deductible at the tax level, and only itemizers benefit. So if you look at the flip side of that discussion or argument, the top 10% of earners pay 70% of the taxes. So if you want to subsidize giving in any way, it makes sense that you'd subsidize those who are actually paying the most in taxes. But as I mentioned earlier, and there have been questions from the audience here on this topic, are there other models that might, in theory, make better sense for the government to be partnering with donors? I mean, there have been suggestions such as a floor before benefits kick in, tax credits. We had a couple of questions about that, opening the deduction to all taxpayers. What other model could possibly work better than our current model?
Well, I'll give you my opinion that is probably not realistic in the current economic environment because it would cost more money. But, you know, I say that the way you make it more fair is make the deduction for charitable giving an above-the-line deduction. And so everybody would be able to claim the deduction regardless of whatever your income bracket was. And, you know, I think that that's the best solution for fairness. Now, is it going to happen? no because of the additional cost. You mentioned in your opening, Peter, about the non-itemizer deduction that existed in the early 80s. I think something like that goes a long way towards being fair. I don't think that taking away the incentive from the people that are providing a bulk of the giving or paying a bulk of the taxes is really a sensible way to make things more fair.
I'll also add to that, Peter, and I agree with what Steve said. We have been sort of actively trying to counter this argument about the unfairness of the deduction. You know, in effect, every taxpayer is treated the same way. He or she is told by the government, by the tax code, that we are not going to tax you on that portion of your income that you willingly decide to forego and donate to a cause or an organization that you care about. And that's sort of a reasonable treatment of charitable giving in a progressive tax code, that people who are taxed at a higher rate will receive a larger proportional deduction for the donations that they make, but in effect everyone is being treated the same in that they are excused from paying taxes on the portion of their income that they donate. And another point that we've been making to people is to draw a distinction between the underlying transaction that's being incentivized by the charitable deduction and some of the other tax expenditures that the President in his proposal has called for, and others on the Hill and other policymakers have supported, about restoring some equity to the code by limiting the amount that taxpayers in the top tax bracket can deduct. And where we think the fundamental flaw in this reasoning is that, unlike, say, the deduction for home mortgage interest or exclusions for employer-provided health care or retirement savings, the charitable deduction is not encouraging behavior for which the individual taxpayer receives a direct personal tangible benefit. So in effect, the taxpayers are not underwriting or subsidizing personal consumption or the accumulation of greater wealth, which could be argued is the case for some of the other expenditures. But in fact, what the deduction is encouraging is people to reduce their own personal income for the benefit of others. So that's, we've been trying basically to fight this question, even the notion of the question being asked.
And I know we're about out of time, but I have one last important point to add. And our concern about a lot of the proposals, whether it's been a floor or converting it to kind of an just a flat tax credit set at some arbitrary level or a cap or whatever. Right now, the deduction just tracks with the tax rate. So whatever the tax rates may be, the deduction will go up and down with that. The second you decouple the deduction from the tax rate through whatever means you do that, then Congress is going to forever be coming back to the charitable giving incentive and whittling away at it. So once you set a 28% cap, some senator has some great project that needs funding, he has to have an offset, and he says, well, why don't we just reduce that to 27.5% or 27%? Same with the floor. It's a $1,000 floor. Now it's a $2,000 floor. So once you decouple it, even if you don't believe that the impact is big now, over time it will be whittled away. And that's what Jeff and the folks in the independent sector and United Way are trying to stop from happening, is a long-term whittling away of the incentive.
So we might have significant motivation to rally against this provision for the simple reason that we're piercing the veil, if you will. We're at the end of our time, and I want to thank you all for participating. I've found this to be especially informative. You'll see the slide that we have up here to address some of the things that our listeners can be doing to educate themselves, to inform their opinion, and to work to understand the impact. Earlier a comment was made that we think that maybe some nonprofit organizations really don't see what's coming down the road. To engage in dialogue with board members and stakeholders, and to voice your concern, most obviously by, once you form your opinion, to contact your elected representatives. I'm going to ask each of you just to take 30 to 60 seconds with final comments, and if there's anything else you think we should be doing to participate in this dialogue responsibly. And let me go in the opposite direction that I did initially, and Steve, ask you to start us off.
Well, you know, I would just really echo what you just said. I think that you cannot underestimate the amount of impact that you and your clients can have on this process. And so, you know, a few phone calls coming in to, you know, offices at the right time, especially if you or your clients have connections with federal policymakers, and just saying, look, you know, this is something that's going to make a real difference, and it's going to hurt people. It's going to have unintended consequences. So I think just that, you know, just everybody getting engaged is really the key.
Una?
Yes, I want to say thank you to all the panelists. I think this has also been a very helpful discussion, very informative. I did want to add a couple of very quick points. The first one being this is a very challenging environment for nonprofits. I think the key is to be informed, to understand how policy changes can affect the current operating environment. And I think the second point is also one that has been raised already, that this is a unique incentive in place that does provide significant benefits to the nonprofit sector. And so making sure that we continue to monitor how this debate is playing out is very important for all of us.
Thank you. And Jeff?
Thanks very much, Peter. And I'll echo Steve's comments from earlier. It's an honor to be part of this panel. Both United Way and the Center on Philanthropy are among the most distinguished members of our community and very effective advocates and sources of information, both for nonprofits and for policymakers. So I'm honored to be able to participate. And I will just add one sort of final last point to what both Una and Steve just said. When you are engaging, and you can't sort of overstate the importance of being engaged with your elected officials in Washington and at the state and local level, frankly, make sure that you communicate. And what makes Steve and the United Way such effective advocates for the nonprofit sector is they're able to talk about these issues in terms of the impact that decisions would have on their ability to serve people in communities across the country. So to the extent we can get away from talking about the impact on taxpayers and talk about the impact on the millions of Americans who rely on the programs and services provided by nonprofits in every community across the country, we're much better off having that kind of discussion.
That's a wonderful comment and a very fitting close to our dialogue. On behalf of my colleagues at Campbell Company, I want to thank you all for participating in this. Thanks to our listeners, and this has been very interesting and informative. And Sarah, let me turn it back over to you.